Welcome to the Deep Dive. We've gathered some recent investor docs, press releases, and news analysis on Salesforce. And our mission today, really just to cut through the noise, unpack their latest results, and look at one really big strategic move. Let's jump right in.
Absolutely. And yeah, first up is their Q1 performance for fiscal 26. So that ended April 30th. And the headline numbers, well, they look pretty solid.
Solid, right? Revenue hit $9.8 billion. What stood out to you in the breakdown?
Well, that 9.8 billion, it's an 8% increase year over year. And importantly, it's still 8% growth, even in constant currency, stripping out the FX swings.
Okay.
Their main subscription and support revenue was $9.3 billion. Similar story there, up 8% year over year, maybe slightly better at 9% in constant currency.
And it wasn't just looking back, was it? The sources mentioned future indicators too, like CRPO.
That's right. Current remaining performance obligation, CRPO, it reached $29.6 billion.
Wow.
Yeah, that's a healthy 12% jump year over year, or 11% in constant currency. So it points to a solid pipeline of future contracted revenue.
And they're definitely making money. Cash flow looked strong in the sources.
It did. Operating cash flow was $6.5 billion and free cash flow $6.3 billion, both up 4% year over year.
Okay.
And they also returned a fair bit to shareholders, right? $3.1 billion total, mostly share buybacks, some dividends.
So looking at those numbers, it was clearly a good quarter. But what did the leadership message seem to be? What were the key drivers they pointed to?
Mark Benioff's comments, they really leaned into this vision of a unified enterprise AI platform. He was talking about agents, data, apps, metadata, all, working together.
Right.
He called out Agentforce specifically, Data Cloud, Customer 360, Tableau, Slack, all central pieces. And he mentioned this goal of enabling a, quote, digital labor force.
A digital labor force, that phrase definitely catches your attention. It sounds like AI agents are core to their future of work vision.
Exactly. And Robin Washington, the CFO, she kind of echoed that, mentioned momentum, the agentic AI opportunity. She highlighted solid execution, innovation, operational focus, all driving shareholder value.
Okay, so beyond the big picture themes, did the sources highlight any specific product areas with, like, standout growth in Q1?
Oh, absolutely. Data Cloud and AI are clearly the growth engines right now. Their combined ARR, annual recurring revenue, is now over $1 billion.
Over $1 billion, wow.
Yeah, quite significant. And the sources say it's growing more than 120% year over year.
Doubling year over year on $1 billion base.
Yeah.
That's incredibly fast.
It is, and you see it in the deals. Nearly 60% of their top 100 deals in Q1 involved Data Cloud and AI. Agentforce 2, their AI agent product, it's seeing uptake. They mention over 8,000 deals closed since launch half paid, but interestingly, they're using it internally too. Agentforce handled over 750,000 requests on their own help site, helping cut case volume by 7% year over year.
So they're eating their own dog food, so to speak. Using it themselves to get more efficient. That's a pretty strong signal.
It is. And just the scale of Data Cloud usage also jumped out. It processed 22 trillion records in Q1. Trillion. Up 175% from last year. And beyond specific products, the sources noted deal breadth. More than half the top 100 deals involved 6 or more clouds. Suggests customers are really consolidating on the platform.
Now, one thing you always see in these investor reports is the mention of both GAAP and non-GAAP financials. For someone maybe tracking the company but not deep in accounting, what's the basic difference? Why do they show both?
Yeah, that's a really good question. It trips people up sometimes. So GAAP, generally accepted accounting principles. That's the standard set of rules here in the U.S. Non-GAAP measures are, well, just that. They aren't standard GAAP, and different companies might calculate them slightly differently.
Okay, so if they aren't standard, why bother using them?
They're meant to give you a supplementary view. Management uses them, investors use them to try and get a clearer picture of the, let's say, underlying operational performance. It helps compare periods, see trends without the noise of certain items.
What kind of noise are we talking about? What gets taken out for non-GAAP?
Typically, the big ones, especially for things like operating margin or earnings per share, are stuff like stock-based compensation. That's a real cost, especially for tech, but it's not a cash outlay tied directly to, making sales this quarter.
Right. It relates more to hiring and retention over time.
Exactly. They also often exclude things like the amortization of intangible assets from acquisitions they made in the past, or maybe one-time restructuring charges if they had layoffs or something.
So the goal is really to isolate the performance of the day-to-day business operations. separate from these other big, maybe non-cash or less frequent items.
Precisely. It's just a different lens to look through. And they always provide the full reconciliation, the math, showing how they get from GAAP to non-GAAP, usually in the appendix of the investor deck if you want to dig in.
Got it.
And you also mentioned free cash flow earlier. That's just operating cash flow minus capital spending, like buying servers or buildings, gives you a sense of cash left over. And constant currency, which we touched on, just takes out the impact of changing exchange rates for a cleaner year-over-year comparison.
Okay, that helps clarify things. So strong Q1, areas like data cloud and AI really pushing forward this digital labor force idea. What about looking ahead? What did the sources say about guidance for Q2 and the full fiscal year 26?
The guidance seems to reflect what they called a consistent demand environment, so steady as she goes, basically. They also mentioned that the US dollar weakened a bit in Q1, and that's expected to provide a bit of a positive currency tailwind.
Ah, so currency helped them out a bit this time.
Yeah, a tailwind's definitely better than a headwind, and it actually helped them raise their full-year outlook slightly.
Okay, so what are the numbers for Q2?
For Q2, they're guiding revenue between $10.11 billion and $10.16 billion. That's 8% to 9% growth year over year, or 7% to 8% in constant currency. Non-GAAP earnings per share projected at $2.76 to $2.08.
And for the full year, you said they raised the guidance?
They did, slightly. The sources show full-year FY26 revenue is now expected to be $41.0 billion to $41.3 billion. That's still 8% to 9% growth year over year, about 8% in constant currency. But it's up from their previous range of $40.5 to $40.9 billion. They also nudged up the full-year non-GAAP EPS guidance. Now $11.27 to $11.33.
So it sounds like they're feeling pretty confident about the momentum, plus getting that little currency boost.
Seems like it. They kept their full-year operating margin guidance the same, 21.6% GAAP, 34.0% non-GAAP, and also kept their cash flow growth targets steady, around 10-11% for operating cash flow and 9-10% for free cash flow growth.
Right, those numbers are important for sure. But the real headline grabber, the biggest news coming out of these sources, has to be the acquisition they announced. They're buying Informatica.
They are. Big news. Salesforce agreed to acquire Informatica for roughly $8 billion in equity value. What's interesting, and one source pointed this out, is this comes after rumors back in 2024 about a deal that apparently fell through, supposedly over price.
Ah.
And Informatica's stock price has come down quite a bit since then.
So maybe they got a better price this time around.
That seems to be the implication in the sources, yeah. The terms are $25 cash per share for Informatica stockholders. Now, the immediate market reaction, one source noted, was actually negative for Salesforce stock, down over 3% on the acquisition news, even though, as another source said, the stock was up 5% after the earnings report itself.
Interesting. So investors like the quarter, but maybe had some initial questions about this big deal.
That's one interpretation, yeah. It suggests some uncertainty, perhaps.
Did the sources say if this massive deal impacts the guidance they just gave for this year?
No, the press release was clear on that. No anticipated impact on FY26 guidance. They expect the deal to close sometime early in fiscal year 27. So this is really a forward-looking strategic move.
Okay, $8 billion. That's a huge amount of money. What did the sources say was the core strategic reason? Why spend that much on Informatica? What's the problem it solves for Salesforce?
Mark Benioff's vision, as laid out in the sources, is all about creating the, quote, most complete agent-ready data platform.
Agent-ready data platform. Okay, that sounds directly linked to the AI stuff we were just talking about.
It absolutely is. The sources make it very clear one of the biggest roadblocks for customers trying to use AI agents, like their Agentforce, is just messy data. Not just the data in Salesforce, but data scattered all across their entire company, often unclean, inconsistent. AI agents need clean, reliable, context-rich data to actually be useful.
Right. Garbage in, garbage out, basically.
Exactly. And Informatica brings that enterprise-wide data validation, data quality control, data management that Salesforce doesn't really have at that scale right now.
So it's not just about connecting to more data sources. It's about making all that data, wherever it lives, actually trustworthy and usable for AI.
Precisely. The sources highlighted that Informatica adds critical tools that complement what Salesforce has. Things like strong data quality controls, policy management for data, advanced integration capabilities maybe beyond what MuleSoft primarily focuses on, and really sophisticated cataloging tools for data governance. And crucially, Informatica's platform holds a lot of rich enterprise metadata. That's the context AI agents need to understand what the data means and how to use it properly.
And wasn't there something in the sources about this supporting a bigger strategic shift for Salesforce?
Yes, this really jumped out at me. It suggests the Informatica deal aligns with a move towards serving enterprise IT buyers more directly.
Oh,
Think about it. Salesforce traditionally sells a lot into sales, service, marketing departments, right? Informatica historically has deep relationships with the central enterprise IT teams, the ones who manage and govern data across the whole company. One source even brought up NVIDIA's CEO talking about IT needing to manage AI agents. This acquisition could give Salesforce a much stronger story for that IT buyer, making their whole AI platform something that can be governed and deployed safely across the entire enterprise.
that's fascinating. So less just a product add-on, more potentially shifting who they sell to and how they position themselves in the enterprise.
It could be, yeah. And the Informatica CEO, Amit Walia, his comment about a shared vision for harnessing data value in the AI era seems to fit right into that partnership idea.
Okay, it sounds like a really big strategic rationale there. Improving the data foundation for AI, maybe expanding their reach into IT, but $8 billion is still $8 billion. There have to be potential downsides or risks, right? What did
Yeah.
the sources flag?
Oh, yeah, absolutely. Like any huge tech deal, the sources point to some significant potential hurdles. One is overlap. While they stress how complementary they are, there is acknowledged overlap, especially with MuleSoft, which is Salesforce's existing big integration platform. Figuring out how to integrate those two, rationalize the products, that's going to be key.
Right, you don't want to pay $8 billion for capabilities you arguably already have or create internal confusion.
Exactly. Another major concern that came up is just the sheer complexity and potentially the time it takes to integrate these two giants. One of Informatica's co-founders was quoted warning it could take 5 years to fully integrate.
5 years, wow, that's a long time and adds a lot of execution risk.
It really does. And the cost itself, $8 billion, it's huge, especially if they can't fully leverage all of Informatica's tech and talent. It raises the question, could they have built some of this data quality stuff internally for less, or maybe bought smaller, more focused companies?
And what about Informatica's position in the market? They've always been seen as kind of neutral, connecting everything, right? Even Salesforce competitors. Does being owned by Salesforce change that?
That's definitely a risk, the sources mentioned. Informatica has long been called the Switzerland of data integration, working happily with everyone.
Right.
Being bought by Salesforce, well, it could make some of their existing customers, especially those using Informatica to connect to, say, Microsoft or Oracle systems, a bit nervous. They might start looking for alternatives if they feel Informatica isn't neutral anymore.
So losing that neutrality could actually hurt the value of the asset they just bought.
It's a potential impact, yes. And finally, the sources also brought up Salesforce's own, let's say, mixed track record with integrating really large acquisitions in the past. They've had successes like turning AirKit.ai into Agentforce relatively quickly, but they've also faced well-known struggles fully integrating Slack into the whole digital HQ vision, or maybe getting the full value out of Velocity for their industry clouds as quickly as hoped. This $8 billion Informatica deal is probably their most complex integration challenge yet.
Okay, so wrapping this deep dive up, we've seen Salesforce report strong Q1 numbers, raise guidance, partly thanks to currency, but mainly driven by momentum in areas like data cloud and AI. And then this huge strategic move, buying Informatica for $8 billion to build out what they're calling that most complete agent-ready data platform.
It's a really clear signal, isn't it? They're trying to solidify their place right at the foundation, the enterprise data layer, specifically to fuel that big AI strategy we talked about, combining their platform strength with Informatica's data management muscle.
What really stands out to me, thinking about the sources, is just the immense scale of data they're aiming to manage and govern now with Informatica on board. If they can actually pull this integration off smoothly, it really could be a game changer for enterprise AI, making those agents way more powerful by feeding them reliable data from literally anywhere in a company.
Absolutely. The potential upside is huge, creating that unified platform that solves one of the biggest headaches in AI adoption.
Yes.
Just getting the data right. But as the sources definitely highlighted, the sheer complexity of mashing these two huge companies together, the potential overlaps, Salesforce's own history with big integrations, it means actually executing on that vision. That might be the toughest test they face.
It really leaves you thinking, doesn't it?
Yeah.
About that incredibly fine line between, massive strategic ambition and the really difficult, messy reality of execution risk when you're talking about these multi-billion-dollar tech deals.
It certainly gives you a lot to mull over regarding the future of enterprise data and AI.
Thanks for joining us for this deep dive.